2 Nobel Prize winners, the most sophisticated math models Wall Street had ever built. $4.6 billion. Gone in months. That's the difference between knowing about bias and being immune to it. In 1998, a hedge fund called Long-Term Capital Management collapsed. The people running it weren't amateurs. They were the smartest minds finance had ever assembled. They walked the global banking system to the edge of a cliff. If intelligence protected anyone from dumb decisions, it should have protected them. It didn't. There's a special kind of dumb that doesn't look like dumb at all. It hides inside the best thinking in the room. It walks in wearing the costume of confidence. By the time we close this case, you'll know exactly what it looks like. Open the case file. The hedge fund was called Long-Term Capital Management, founded in 1994 by John Merriweather, a legendary bond trader who had built the most profitable arbitrage desk at Salomon Brothers in the late 80s. Merriweather didn't want just traders. He wanted theory, so he recruited Myron Scholes and Robert Merton. Both would win the Nobel Prize in Economics in 1997 for the option pricing model that still bears Scholes' name. He brought in a former vice chairman of the Federal Reserve, PhDs from MIT and Harvard. The room had more raw intellectual horsepower than most graduate economics departments. The strategy was elegant. Find tiny pricing gaps between related bonds. Gaps so small that, on their own, they would barely cover lunch. Then leverage. Borrow heavily. Multiply small edges into big returns. From 1994 to 1997, the fund delivered over 40% per year. The financial press called the founders the masters of the universe. Banks lined up to lend. Money poured in faster than they could deploy it. Now look closer. The numbers stop being elegant and start being strange. By early 1998, LTCM had roughly $4 billion in actual investor capital. That capital was supporting positions worth $125 billion on the balance sheet, and over $1 trillion in derivative exposure. Leverage of 30 to 1 on the books. Effective leverage closer to 250 to 1 once derivatives were counted. One investor, Seth Klarman, had refused to put money in from the start. He said it was reckless to combine that much leverage with models that didn't account for rare events. He was ignored. 2 Nobel laureates were saying it would work. What does Klarman know that Scholes doesn't? 8 months later, the fund was bankrupt. 4 books explain why. Each one disagrees with the others about which mechanism actually killed it. Start with Daniel Kahneman. Kahneman spent 40 years studying how people actually make decisions, and he won the Nobel Prize in 2002 for it. His central claim is simple. The brain runs 2 systems. System 1 is fast, automatic, intuitive, pattern matching at the speed of reflex. System 2 is slow, deliberate, analytical, the part that does math on paper. System 2 thinks it's in charge. It isn't. Most of the time, System 1 has already made the decision, and System 2 builds a story to justify it. Now, here's where it gets weird. The default assumption is that if you train someone hard enough, Nobel-level math, decades of experience, expert credentials, System 1 just turns off. Slow, careful thinking takes over. The pros are above the noise. That's not what Kahneman's research shows. System 1 doesn't turn off when your IQ goes up. It gets a louder voice. The smarter the person, the more eloquent the rationalization their gut produces. Override doesn't happen. The justifications just get more elegant. Apply this to LTCM. The founders had a model, Black Scholes, that priced options beautifully under normal market conditions. The model assumed price movements follow a bell curve. Most days that's roughly true. The fund made billions trading on that assumption. Every successful year reinforced the same System 1 pattern. The model works, trust it, lever it up. When Seth Klarman warned about rare events, System 2 should have asked the question, what happens to our positions if the bell curve breaks for 2 weeks? It didn't ask, because System 1 had already answered. The bell curve had held for years. It would keep holding. 2 Nobel laureates agreed. Question closed. The same pattern killed 7 astronauts in January 1986. NASA engineers warned that morning that the Challenger's O-rings might fail in cold weather. They had data, charts, a careful System 2 case for delay. The decision-makers in the room had a different System 1 pattern running. The launch schedule was tight. The previous flights had worked. The pressure was political. The shuttle launched at 36 degrees. It exploded 73 seconds in. Kahneman would say the same thing about both cases. The smart people in those rooms weren't unaware of risk. They processed risk through the wrong system. System 1 had already concluded, this is fine, before System 2 even got the question. Remember that special kind of dumb from the opening? This is one layer of it. Not stupidity. Overconfidence dressed up in math. But Kahneman's lens has a limit. He explains how the brain makes the mistake. He doesn't explain why smart people keep making it even after reading his book about it. Nassim Taleb's answer is harder to swallow. And it cuts deeper. The human brain isn't built to think in probabilities. It's built to think in stories. We take a sequence of events that actually happened, and we reverse engineer a clean narrative that makes it look inevitable. In The Black Swan, published 2007, Taleb calls this the narrative fallacy. It's not laziness, it's the default operating system. Training doesn't save you from narrative fallacy. It just upgrades the story you tell yourself. Apply this to LTCM. The fund didn't run on intuition. It ran on 30 years of historical bond price data, fed through models that produced precise probability estimates. The traders weren't telling themselves a story. They were doing math, except they were also doing both. The math told them what had happened in the past 30 years. The story told them the next 30 would resemble the last 30. That second part was never in the model. It was in the room. It was in the confidence. It was in every meeting where someone said, history shows, and nobody asked, history shows since when? In August 1998, Russia defaulted on its sovereign debt. Markets did something the 30-year data had never seen. The story broke. The fund went with it. The same story trap that ate LTCM ate Isaac Newton in 1720. Newton, possibly the most analytically gifted human who ever lived, bought shares in the South Sea Company early, sold at a clean profit, and walked away. Then, he watched the stock keep climbing while other investors got rich. He told himself a new story. He had been too cautious. The market knew something he didn't. So he bought back in. Near the top, lost the equivalent of millions in today's money. He's reported to have said he could calculate the motion of heavenly bodies, but not the madness of people. Wrong diagnosis. He could calculate the heavenly bodies. He couldn't catch himself building a story to override the calculation. The story Newton told himself after selling early sounds almost identical to the story LTCM's traders told themselves 3 weeks before bankruptcy. Same shape. Different decade. Taleb's lens explains the pattern Kahneman's lens couldn't quite reach. The risk doesn't just get processed through the wrong system. It gets processed through a narrative that's already filtering what counts as evidence. But Taleb stops at the story. He doesn't ask why the same story shape repeats across centuries, across industries, across IQ levels. That's the question Dan Ariely spent his career answering. Ariely's lens is the most uncomfortable of the four, because his answer is, it's not your fault, and it's not even about intelligence. It's about wiring. His experiments, running for over 25 years at MIT and Duke, with subjects ranging from undergrads to senior executives, show that human beings make the same irrational decisions in the same situations with terrifying consistency. Anchoring on a number we just saw, overvaluing what we already own, treating free as if it has no hidden cost, loss aversion that makes us cling to bad positions long past the rational exit. These patterns don't disappear at high IQ, they just run at higher resolution. Apply this to LTCM. The traders weren't just telling themselves a story, as Taleb would say. They were anchored on their own track record. 3 years of 40% returns is a hell of an anchor. Once that number is in your head, every new risk gets compared against it. A position that would have looked insane to a first-year analyst looked routine to a partner who had personally cleared $500 million the year before. The anchor moved everything downstream. Risk tolerance climbed, leverage climbed with it. The line between caution and bold quietly disappeared. The leverage finished the fund. Loss aversion finished the job in a different way. When the position started bleeding in August 1998, the rational move was to cut and walk away. Instead, the partners doubled down, because closing a losing trade meant accepting the loss as real. Ariely's research predicts this, exactly this, at every IQ level he tested. Here's where it gets uncomfortable for anyone listening. The same pattern ate one of the most celebrated retail executives of the last 20 years. In November 2011, Ron Johnson left Apple to become CEO of JCPenney. He had just spent a decade building the Apple Store from zero into the most profitable retail square footage on Earth. He arrived at JCP and immediately killed the coupons, killed the sales, killed the markdowns. Replaced them with a fair and square pricing system, clean, premium, Apple-like. JCP customers hated it. Sales dropped 25% in his first year. The company lost roughly $4.3 billion in sales in 2012. Johnson was fired 17 months in. Ask Ariely what happened. He'd say Johnson didn't fail because he was stupid. He failed because he anchored on the wrong reference point. Apple customers were his anchor. JCP customers were not Apple customers. The anchor never moved. Predictable, in Ariely's data, at every level of expertise. 3 lenses, 3 different mechanisms. None of them explain why 14 of the smartest banks on Wall Street all made the same bet on LTCM at the same time. The 4th lens belongs to Robert Cialdini. Cialdini's lens gets underestimated because it sounds soft. Social proof, authority bias, liking, reciprocity. These are the mechanisms Cialdini cataloged in Influence, originally published 1984, and has refined ever since. The instinct is to assume social proof only operates on amateurs, people who don't know any better, copying the crowd. That's not what Cialdini found. Social proof operates more strongly inside expert communities, not less. Because in a room full of credentials, the cost of being the lone skeptic goes up. You're not just disagreeing with one person, you're disagreeing with the room. Apply this to LTCM. Look at who lent the fund money. Merrill Lynch, J.P. Morgan, Goldman Sachs, UBS, Bear Stearns, Lehman, Salomon Smith Barney, 14 of the largest financial institutions on the planet. Each had its own risk department, its own quants, its own access to LTCM's positions. None of them said no. Why? Cialdini's answer is that they were watching each other. If Goldman is in, Merrill assumes Goldman did the due diligence. If J.P. Morgan is in, Bear Stearns assumes J.P. Morgan checked the leverage. Each bank's yes was partly based on the other bank's yes. Nobody was the first to walk away because nobody wanted to be the only one who walked away. That's not laziness. That's social proof inside an elite room. The same mechanism explains the most analyzed board failure of the last decade. The Theranos board, between roughly 2011 and 2015, included Henry Kissinger, James Mattis, George Shultz, William Perry, Sam Nunn, former Secretaries of State and Defense, generals, senators. By raw credential density, possibly the most decorated corporate board in American history. None of them caught the fraud. The standard explanation is that Elizabeth Holmes was an unusually persuasive con artist. Cialdini's lens says that's incomplete. What that board had was extreme authority bias inside its own room. Each member's presence vouched for the next. Adding Kissinger raised the perceived legitimacy of the whole structure. Mattis added more weight. By the time the board was complete, the room was credentialing itself. None of them were the doctors or technologists who could have caught the science, and none of them had to be, because the room felt right. It wasn't a moral failure of individuals. It was a predictable failure of a particular decision environment. 4 lenses now, 4 different stories about what killed LTCM. They contradict each other, so which one is right? Trick question. They all are. Each lens on its own misses something. The 4 mechanisms don't compete. They stack. Kahneman's system. One doesn't quiet down at high IQ. It gets a louder voice. For Taleb's narrative fallacy, training doesn't help. It just buys a more sophisticated story. Ariely's anchoring grips experts as tightly as anyone else, and the only thing that changes is what gets anchored on. And Cialdini's social proof? Inside a credentialed room, it strengthens, because the room is harder to leave. Now read those 4 lines again as one mechanism. Intelligence isn't an antidote to bias. Intelligence is a louder voice for bias. Every cognitive advantage a smart person has, pattern recognition, memory, fluency, status, credentials, gets recruited by the same biases that operate in everyone else. The biases don't disappear. They get better lawyers. That's the hidden mechanism. It's why LTCM blew up. The same wiring dragged Newton back into South Sea shares at the peak. It kept Ron Johnson anchored to his Apple playbook long after the JCP data screamed wrong customer. It let the Theranos board credential a fraud they had every credential to catch. None of these people were stupid. Each was using significant intelligence to defend a position the 4 lenses can predict in advance. Remember the special kind of dumb from the opening? Here it is. It doesn't look like dumb. It looks like a smart, articulate, well-credentialed person making a confident decision, using their full intelligence to justify a bias they cannot see in a room full of other smart people who can't see it either. That's the mechanism. That's the case. 2 Nobel laureates, the most sophisticated math models Wall Street had ever built. $4.6 billion. Gone in months. Now you know exactly what that special kind of dumb looks like. And you know it isn't dumb at all. It's intelligence pointed in the wrong direction. A note before we close the file: this is educational behavioral analysis, not clinical psychology, and not personalized financial advice. The interpretations here apply lenses to public cases. They don't diagnose individuals. For your own decisions, talk to qualified professionals who know your situation. The question to carry out of this case is simple. Next time you're in a room full of credentialed people making a confident decision, including when that room is your own head, ask which of the 4 lenses you're missing: Kahneman, Taleb, Ariely, Cialdini. One of them is usually already at work. You just haven't noticed which. Subscribe to see the next case decoded. Next week, why a Series B founder fired his best engineer to save the company. The lenses won't be the same. The mechanism will surprise you. Close the file.